Hey, good morning. This is Ralph Mendez, and we're going to talk about current liabilities, how to do your homework, Chapter 9, as it pertains to liabilities of a company. Now, on the first one, it says record the cash sales in sales tax. Sales tax. So, y'all are all familiar with this. So, look, here are the sales tax is an important source of revenue for the states. I think 45 45 states have sales tax, and they're more important to states even than local municipalities, which have property tax revenue. City, county, municipal rates vary. These rates are weighted by population, computing average local tax. But California has its highest state level sales tax rate at 7.25. I think Texas is 6.25, and then plus the San Antonio, no, probably 6 plus the 2 of San Antonio end up at 8.25. So sales tax is big, a big source of revenue. Okay. So you have cash sales of how much? 15,000 cash. So cash is sales of 15, sales merchandise for 15,000 cash. Okay, and the sales, what were the sales? Cost of merchandise 12, collects 5% tax. So record the entry for the 15,000 sales and its sales tax. So sales tax payable, 5% of that is what? $750. Sales are 15. So the cash is going to be 15,750. All right, let's just see if we're right. Then the cost of goods is 12%. So what happens? What happens to your inventory when you make a sale? It costs you 12, you sell it for 15. So inventory is going down. Well, I thought I could find inventory. And it becomes an expense called the cost of the goods sold. Okay, and then what happens? You have to send the money in to the government. So the liability goes away how? With a debit. And what do you credit? You're going to credit cash. Cash, let's check our work. So cash comes in, the sales tax is collected on top of it. You have a liability, you adjust your inventory, and then you send the money into the government. And is it important to states? Yes, it's very important to states. Let's go all the way back up. 45 states and the District of Columbia collect statewide sales tax. Local sales tax are collected in 38 states. They can rival or even exceed the state rate. The 5 states with the highest average combined state local rate are Tennessee 9.5, Louisiana 9.52, Arkansas 9.4, Washington 9, Alabama 9. No state rates have changed since Utah increased the state from 5.99 by 6.1 and 19. So the very important source of revenue for the states. All right. And think about the COVID, what it did to sales. And, I'm wondering though, if Amazon does it, so all these people buying for Amazon, so what's happening to the sales tax collections? Are they having to pay sales tax on what they sell to Texas? And so is Amazon causing problems to state governments? All right, now, unearned revenue, receives 4.52 million in advance. Cash. And what is it when you get money in advance? It's unearned. The unearned ticket revenue. So now it says for a 4-date tour of Bon Jovi, record the advance ticket sales on October 31st, record the revenue earned for the first concert of November 5th. So if you divide 1,4520, how much did they earn after one concert? So what happens? Liability goes down with what? A debit or credit? and revenue goes up. You receive cash, it's a liability. You perform some work, you earn the revenue, liabilities go down. Now, pre-COVID, the business behind advanced payment and ticket revenues. So the thing is, COVID-19 refund policies for season tickets, season passes, and annual festivals. It's so look at this though, whether it be a professional sports team using advanced ticket sales, the money is being used right away, even though they're being used right away. As such, any refunds will necessarily come from other areas of an organization's balance sheet. So how many people can do that because of what happened with COVID? So they've already spent the money, and then all of a sudden, students that were sent home, they want the money for the dorms, can't go to a club or gym. But one of the reasons they like to have advanced ticket sales, all organizations value advanced payment. It provides some connectivity between the customer and the organization. So if an event is postponed or canceled, the consumer has the option to pick another event to attend. The consumer will then be given the right to pick an event the following season. So the thing is, what happens now? Now you have class action lawsuits and other litigation against sports league team and ticket brokers. Class action litigation is the major, in the sports context, coming to suit filed against Major League Baseball's major ticketing broker partners. The suit, which was filed on April 20th in California, despite both plaintiffs being New York residents, alleges the failure to provide refunds violated California's Consumer Protection and Unlawful Business Practice statute. Failure to provide refunds, since the sporting events paid for will not be taking place. So anyway, this is an important issue as well about unearned revenue, ticket revenue. You've collected the cash, right? You've collected the cash. And then what do you do now? The things are canceled. So COVID has even caused class action lawsuits based on that. So again, these things we talk about are real world. All right, next, interest-bearing note. Now, the reason why is you signed this note on November the 7th, and it's a 90 days. So November, December 7th, January 7th, February 7th, somewhere around there is 3 months. But you're not going to pay interest till in February, but you have to accrue from November to December 31st when you got to make the adjustment. Compute the accrued interest payable. And the formula is principal times rate times the time. The principal is $240,000 cash. The rate is the 11%, but the time. So how do you get the number of days from November 7th? 30 no days in November minus 7, that's 23 plus 31 in December. I say that again, 30 days in November minus the day you signed the note is 23 plus 31 is equal to 54 days till the end of the year. And they're going to do the math? I thought it would do the math. So interest recognized. So now in year-end interest accrual. Oh no, this is through maturity. I'm sorry. So this is the whole time frame, 90 over 360. Now to the end of the year, 24, 11, and then this is the 54 over 360. And then the interest recognized on February 5th would be the difference, 240, 11%, and then 54 minus 90. So how many days is that? So that's 36 days in next month. So 36 in the 54. So now we got to do the math. 240,000 times 0.11 times 90 divided by 360. So this is 6,600 for the whole time frame. And then 240 times 0.11 times 54 divided by 360. So that's 3960. And then the difference here will be the other for next year. Now, so 3960, 2640. So now how do you make the adjustments? So this is for the whole period of time. This is through the end of the year, and then this is in the next year. And I try to think of a calendar. So here you're signing this note in November, and from here to here, there's some interest earned, but you're not going to get paid till over here. So some interest is earned here, some interest is earned here. You don't get the money here, but you got to make an adjustment right here at the end of December. All right. So, and there's the amount. So 3,900 goes into this year and 2060/40 goes into next year. So how do you say that? Record the accrued interest on the end of the year. So what is it here? So first off, what is it here? What are we doing? Borrows money. So it's an interest expense and interest payable at the end of the year. And then that's the 3,960. So here we owe the bank or someone money, and it's an expense. Rent on money is interest. Interest is rent on money. You don't have the cash, so you got to pay somebody else rent for the money to get it. All right, so now what happens on February the 5th? So now you have interest expense. The liability goes away from last year. So this 3,960 is credited, and now it's debited because that goes away. And then now, how much interest expenses is this year till February? And then we have to pay the note. The note goes away, 240. And all that added up is the cash that we have to pay out. So we have to pay the cash of 24,660, right? Let's see, did I do the math? 345, 65, 66. All right, so now let's check our work. So interest expense till the end of the year, interest expense next year till February, get rid of the liability, and you pay all 6,600 now to the company and the note goes away. All right, and again, you're in this year, 2021, there's 2022, you sign a note, you owe interest for this period, and then you're not going to get the money till February. So you got to put some of the interest expense in this year and some of the interest expense in next year. All right. And then you got to pay everything back in February. So I hope you all see that from this journal entry. All right. So let's see what happens next. All right. Number 4, accounting for a note. So now you borrow 119,000 by signing a 60-day note. Okay, so you borrow 19 on May 15 by signing a 60-day, 7%, $119,000 note. On what day does the note mature? So they want you to do the math and see if you know what to do. So how do you do May? How many days are in May if you sign it on the 15th? 31 minus 15 is equal to 16 plus 30 days in June, right? So 31 plus those is 46. And I need it to 60. So I'm going to say it's June 14th. It's a 60 day, right? May. Oh, I guess I'm July 14th. Sorry. All right. So my timeline, I got rid of it. Now, how do you get the interest? Record the issuance. Well, we borrowed money. So we get cash. And we have a note payable. Cash goes up as a debit, liabilities go up as a credit. Okay, what happens next? What's the formula for simple interest? Principal times the rate times the time. Principal times the rate times the time. And the interest is, so do the math, 119 times 0.07 times 60 divided by 360. I get 1388. Doesn't feel right, but try it again. How much should we borrow? 119 times 0.07 times 60 divided by 360. So 1388 is what I have. And how do you make the journal entry? Record the payment of note in maturity. So I'm going to say the note payable goes away, 119, and interest expense of this 1388. What am I supposed to do? Round final answers to the nearest dollar. So I just rounded it to 33 to nail. And I got to pay cash of 120,388. Okay, is that everything? We did our 4 things. Let's just check our work. So here's the note where that's that journal entry where we're paying it back. Let's go to the beginning. July 14th, that was the right date. We borrow money, we owe a liability. Here's how we use it. Now this is simple interest, PRT. That's simple interest, principal times rate times time. That assumes only one compounding period. So, but you're going to learn in math classes that, look, here's the real formula. The amount, the interest is principal times the rate times the time. So in our case, we're just using simple interest. Principal times the rate times the time. Principal, rate, time. But in real math, you can have more compounding periods than one. So you take the interest rate, in our case, would have been 7. Let's just say we want it every day. We want interest every day. So interest rate 7 divided by 360 raised to the time, number of times interest is compounded per unit. So principal times the rate times the time. But it's different though when you want compound interest. Principal, rate, time. Well, what's the principal's the same. What about here? The interest rate divided by the number of times the interest is compounded. So if it'd be monthly, it'd be divided by 12. And it'd be how many years times 12. So if it was a 1 year, it'd be 1 times 12. It was 2 year, it'd be 2 times 12, 24. So here now, what about if it's daily compounded? It'd be the rate divided by 365 raised to the 365 times however many years. So please understand, compound interest is not the same as simple interest. Principal, 1 plus I raised to the t. Okay, so anyway, this is a better formula over here. So I'm sure y'all are learning that in your math. Okay, principal times rate times time, but you can have compound interest. Okay, all right, let's go on. Let's see what else we have in this problem here. Recording to warranty. Expense. So we sell a mower that cost $160 for $460 and a 1-year warranty. So on January, and warranty is estimated to be 12% of sales, 0.12 times 460. So we're saying that the warranty expense estimate is 55.20. So to do decimal places, please. And it's warranty expense, estimated warranty liability. So we just based it on our knowledge, our experience. Estimated to be 12% of sales. On January 12th, 24th of next year, the mower is bought for repairs under warranty ward, requiring $32 of materials. Oh, I'm sorry, put the wrong one here. This is just cash 460. And the number 2 is estimate the warrant, record the cost. Cost was 160. Got ahead of myself there. What does it become whenever you sell something? It becomes an expense called cost of goods sold expense. Inventory goes down. Now we estimate the warranty. How do we do it? We're going to use 12% of sales. Warranty expense, 5520. Estimate, it's an estimate. You're allowed to use estimates in GAAP. In accounting, you use estimates and assumptions and things. And over here, somebody actually comes in and you have to spend $32. So $32, our estimate goes down because it's a credit when we estimate it, it's a debit when we use it. And then we have here parts inventory, whatever we had, let's see. We had to take parts here. There it is, repair parts inventory. All right, so let's take a look. Oh, I made it, instead of putting 460, I put 450. So I hope y'all see that. Cash sales, adjust your inventory, make an estimate of your warranty. And then when somebody actually comes in, you have to journalize that warranty expense. Now, look at the worst. Now, this is right here from last week, a few days ago. If you've been in the market for a home warranty, so see, there are warranty companies: American Home Shield, Choice Home, Select Home, Amazon, First American. And then this article gives an opinion of, who's not a good home warranty company and why. So, um, so warranties are a big business. Like most house sales, they usually include some kind of warranty expense. Hey, on the air conditioners and things. So warranty, and then there's been lots of recalls. I think Ford has had the most recalls, but the biggest ones in history, here they are: Takata airbag. I don't know if y'all remember that. $24 billion in counting. What began over a decade ago has escalated the biggest recall in history. Faculty airbag inflators made by now bankrupt Takata were used by virtually every major manufacturer on the planet. And I actually remember a student in class that his dad worked at Takata, because one of the offices, one of the buildings right there by Northwest Vista, it was a Takata company. So anyway, 41 million vehicles were recalled to replace 56 million Takata airbags that could explode, hurling metal shrapnel. So what an overall horrible thing, and it's terrible for the company that's broke. And then Volkswagen diesel engine recall. See, customers and shareholders were both stunned when German car giant was caught cheating on diesel emission test. It was discovered that for years, the company employed software that allowed its turbocharged diesel to cut their emissions to meet regulatory standards. And then Vioxx recall, Firestone tires. So Samsung's Galaxy Note recall 2016. So I don't know if any of you had. The world's largest smartphone maker was forced to discontinue and recall the priced Galaxy Note 7 after complaints that some started bursting into flames. So I'd really like to know if any of y'all had that happen to you. All right, and then ignition switch in 14 from General Motors, Pfizer, Toyota had a recall of floor mat, Peanut, we had a salmonella outbreak. All right, so recalls can, make you bankrupt, just like Takata. So it's a big issue. So you have to estimate. Now, in the next one, we're doing payroll. We're doing payroll. What is your gross pay? The records of Speedy Software show the following information about Marcia Godsack, an employee. Claims 1 allowance, computer, Social Security, Tech, Medicare, federal withholding, using the withholding tables in 9.6. So her gross earnings for the current pay period is 610. And her Social Security deduction is, let's see, it's 6.2, right? 6.2% of that. 10 times 0.062. So 3782. Her Medicare tax is 1.45. 0145 times 610. 8.85. Her income tax deduction. So her cumulative earnings of previous pay period is 7930, and it's 610. So I'll have to go to this withholding table, and it's 610, and she claims 1, it's $69. If the wages are 600 to 610, at least 610, but less than 620, less than 610. So it's right here, this one here, and claiming 1 is the $69. She claims 1 allowance. Now the state income tax, how much is state income tax? Is 1%, so that'd be $6.10. Her net pay, this is her gross, minus Social Security, minus Medicare, minus federal income taxes, minus state income tax. And let's see how we did. So again, this is your gross, this is your net pay. Gross pay, net pay, what comes out of your check? Social Security, Medicare, income tax, and state income tax. Now, please realize your employer has to match Social Security and Medicare. So let's see here if I have it here. Okay, we don't. And how about here? So now this is a history of Social Security, which is part of in the 1930s, they passed the OSADSI program, OASDI. What does that stand for? Old age, survivors, and disability insurance. Now, do you have anybody in your family on Social Security? That's the old age part of this help. Survivors, a couple of years ago, I had a young lady in class named Nicole. They were stationed in Leavenworth, Kansas. They were in a wreck. The husband died. So her and her young son, they collected survivors. Very important program. Disability. Do any of y'all collect disability insurance? Someone in your family, disability under Social Security. So look at the rates. So, they started off like 1% many years ago in the 30s, 1%. But now here, since 1990, it's 6.245 for 6.2 for Social Security, 1.45 for a total of 7.65. And your employer has to match those. So if you make $100, Social Security, you make $100, $6.20 have to come out, and $1.45 have to come out for Medicare. And in this case, World Vision, I'm just saying, is $5. And what do we have next? Blue Cross Blue Shield, your insurance is $20. So 25, 30. So you got 100 gross, but your net's only 67. You paid your Social Security, you paid your Medicare, you paid World Vision, you paid your health insurance. So there's gross pay, net pay, and all of you can relate to that. All right. And let's see. Now, all right, so very good. Just another one or two. According to payroll, what does it say? January end of pay period, and earned 28,000 of sales salaries. So sales salaries. No. Sales salary expense. Isn't it salespeople? 28,000. Sales salary expense. Sales salaries, yes. No, we'll just put salaries expense. And then what else is taken out? Withholding, Medicare, federal income tax. So we took out FIT, federal income taxes, Social Security, Medicare. So these are all taxes taken out. 6.2, 1.45, 616 of medical insurance, health insurance. Employee medical insurance, and what else? We got 180 of union dues. There you go. So now how much is this? So take 28,000 times 0.062 is 1736 here. And then you got to take 28,000 times 0.0145 is this amount here, 406. So now you got 28,000. And then what is this one down here? It's the net amount. It's what you get. So what is that? So salaries payable. So record the employee payroll for the period. So I don't know if they want us to give cash or not. So let's just put salaries payable right now. 21,000 minus 1736 minus 406 minus 3,300 minus 616 minus 180. So your net is 21,762. And let's check our work. All right, so here's your salary expense, but you got to pay Social Security, Medicare, federal income taxes, health insurance, union dues, and this is what the net amount you're going to get when we actually pay it. All right, so this chapter's, all right, so now let's look. 10 employees, 1,700 a month, so it's the same kind of problem here. Record the employer payroll taxes. All right, now let's just check here what I have. So I've explained this to you. Back in the 30s, the government passed this, and it's really been a wonderful program. So it needs some help. It's been like 85 years. It could use some help. So, because a lot of people collect Social Security now in the country, millions. And I think the rates should go up a little bit. And the Medicare premiums are not very expensive, what we pay for health insurance. Okay, so old age, survivors, disability insurance, 6.2 you pay, 6.2 your employer, 1.45 Medicare, and you pay 1.45. Now, I would also like to show you that Social Security stops at a certain point. Social Security stops after a point, and Medicare is unlimited on your pay. So what do I mean by that? Social Security limit is 142,000. Last year was 137,700. So as soon as you make 142,800, it stops. So LeBron James and high paid, movie actresses, actors, managers, sports people, they pay the first week of January and that's it. They don't pay Social Security the rest of the year. I really think even making this unlimited would help the country. They talk about raising taxes. Well, if people are getting paid $1 million or 20 million, why shouldn't they be paying Social Security? It would help the fact that it could run out. So it stops right now. It stops right now. Medicare stops. And here's the limit, somewhere around 147. What did I say now? So it stops here at 142.8, somewhere in here, right in here. All right. So Medicare stops, and Medicare is unlimited. Social Security stops. All right. So now 10 employees. Let's just see, been employed January, gross pay, FUTA. So let's see, we'll probably stop after this one. So in this case, we're talking about the employer, what the employer has to pay payroll tax. In the previous problem, that's recording what the employees are. So here you have payroll tax expense, and you're going to have Social Security payable, and you're going to have Medicare payable, and then you have FUTA. What do you have? Do we have federal unemployment? Federal unemployment taxes, state unemployment taxes, and you don't pay this. The individual doesn't pay this. The employer pays this. So now you can't tell what the total is until you add up all these things. So there's 10 people and they pay them $1,700 per month. So right away, 1,700 times 10 is we have 17,000 of wages times 0.062. So there's 1,054 we owe there. And then that's pretend you're the employer. You got 10 employees, pay them 1,700. And then that's times the 0.0145 right here, 0.0145 of gross. So you owe 246.50. What does it say? Round your to 2 decimal places. Very good. And how about FUTA? That's federal unemployment, and SUTA, 0.6% is 0.006 times 17 is $102 of federal unemployment. And a lot of people have been collecting unemployment compensation in what's happened here. And then this is 0.054 times the 17, and that's $918 of state unemployment. That goes to Texas. And let's check our work. All right. Now it's saying it's not complete. I'm not sure I see what's the matter. We'd have to return to the question. Let's see. Oh, view the journal entry. Well, they got another entry. Oh, I needed to add it all up. Did I forget to add it all up? You add all that up and that's your payroll taxes. Now, I want you to FUTA. The federal unemployment tax is a payroll tax paid by employers on employee wages. The tax is 6% on the first 7,000 of any wages. Any earnings beyond that, so it's only on the first 7,000 for FUTA. Okay. Now, state unemployment. This is Texas. What is Texas FUTA? Here's the historical. They paid on $9,000, and this is the maximum rate. Now, it depends how much turnover you have, but the UI tax funds unemployment compensation programs for eligible employees. In Texas, state UI tax is one of the primary taxes employers must pay. Okay. So, and this is how we fund our unemployment insurance. All right. I hope this helped you a lot, and y'all have a wonderful day, and good luck on this chapter. Thank you very much.